I'll record on the perfect. Okay, so like we were just kind of really talking about a little bit. So welcome everybody. I want to introduce today Mr. Bill Fairman. He is a fund manager as well as this good-looking guy back here on his book with the high performance entrepreneurs. Talks about with the collaboration of a collaboration with other authors and talking about how you fail your way to success. So we'll dive a little bit more into that. But Bill, I wanted to thank you for taking some time out today and jumping on and just having a conversation with us.
My pleasure, Ernie. I appreciate you asking me.
Absolutely. Well, so I know a little bit of your background, but I want to just kind of open that up to you, if you will. Kind of tell us how you got started in the fund side, fun and fund, right? So in the fund side, and then obviously, kind of where the book came in at, and then just kind of work through your entry into this.
Sure. So I've spent a little over 20 years in the mortgage industry, starting from being a retail um, mortgage originator, doing conventional mortgages. Eventually, and I was doing that for quite some time. I ended up going to work in a company that was a wholesale lender. And all that meant was that when I would write a loan, I would send it to a company that would be a wholesale lender, and then they would end up funding the loan. So I became one of the wholesale lenders, and I would call on other mortgage companies. And I did that for quite some time. So the advantage there was I got to see thousands of transactions in a short period of time. So you end up drinking from the fire hose, so to speak, and you understand the industry, and
Yeah.
you hear all the tales when someone's trying to apply for a mortgage. I spent just before the crash of 2008. I spent the 5 years leading up to that on the small balance commercial side of the mortgage industry. So I have quite a bit of experience there as well. I made that transition. It I was told, I thought it was kind of easy, but I was told it was kind of hard for retail loan officers to transition to um, the commercial space because it's a different way of underwriting and looking at properties, and then understanding the different property types and how they're viewed from an underwriting perspective. But the mortgage industry, the underwriting piece of it is a lot like the insurance industry. All you're doing is taking risk and adjusting for it, and then you're adjusting your pricing and how much you'll lend on any particular asset based on the risk that's involved. And you're including the property type, you're including the borrowers. So it's fairly similar to the insurance industry. The difference with the mortgage industry is that you're regulated more than the insurance industry.
Yeah.
And the insurance industry is regulated heavily. Now it's the mortgage industry is super regulated. But we had the crash in 2008.
Yeah, 8, 9.
And myself, like many others, found ourselves. If you're on the sales side, there was no mortgages being written after 2008, or very few.
Yeah.
And so our industry had shrunk to about 25% of the size it was before then. So a lot of us ended up, especially on the sales side, the origination side, we were all looking for work. And, when you're in middle management sales, um, it's hard to find a job as somebody that's going to answer the phone. So I couldn't get even the simplest mortgage job at a bank because I was overqualified. Basically, what they were telling me, I was not hireable.
Yep. Yeah.
Um,
I've had that a few.
so I ended up, you have to do what you need to do to pay the bills, and I needed to keep my house. And so I ended up, after a few jobs, I ended up driving a tractor trailer truck for 2 years, 2.5 years. Um, my sister Wendy was also in the mortgage business, and she had to close her mortgage company down, and she went into seminary school. So we both took different paths, but the one thing that was constant is that there's still problems to be solved. And during that time, the banking industry was very strict, and there were still people that needed money to do things. And uh, Wendy had been working for a while doing uh, hard money loans on the side. So she knew people that had self-directed IRA accounts that needed to invest their money,
Mhm.
and she knew people that needed money to buy homes, fix them up, and then sell them. And so she was doing that on the side. And when she got out of seminary school, and this, I kid her because her major was in nonprofits, and she keeps making money. So she's a failure at the nonprofit business.
Failure at the nonprofits.
So her little side business started growing, and I had actually moved from around a $28,000 a year job as a truck driver to around $90,000 a year within 2.5 years. Um, so I was nesting. Does that make sense? I've been in sales or commission sales or self-employed for most of my adult life, and I never wanted somebody else to dictate my potential earnings.
Certainly.
It all falls on me. But after the shock of 2008, uh, I had started nesting. I was feeling comfortable knowing exactly what I was going to get. And it took her a little while to talk me out of the truck and into going into business with her, which I finally light bulb came on and said, "What are you doing? This is a terrible it look, it driving a truck is a noble profession, but it's not a great lifestyle. You're gone all the time. It's dangerous. When you're out there on the road all the time, it's people get worried about flying an airplane. If you're trying to get life insurance and you're a pilot, it's not that you can't get life insurance, but your premiums are going to be a lot higher.
Sure.
If it's funny, if you're a truck driver, your premiums aren't any higher, and you're in more danger from having an accident than you are in an airplane.
Yeah. Yeah,
Because
because you
again,
got some people that are out there just intentionally causing, those because of
yeah, you had that, but they're not trying to kill you because they don't want to die either. They just want some insurance money.
yeah,
So those are minor fender benders. But the fact is, you're in a vehicle that's really heavy. It's hard to slow those things down, and it's no different than if you're doing DoorDash. You're just out there a lot more often
yeah,
in traffic, and it's the odds are that you're going to have an accident at some point because you're just exposing yourself to a lot more potential accidents. That's all.
yeah.
But anyway, uh, I digress. Wendy and I started in business together, and that's all we did in our business is we knew people that had self-directed IRAs,
Mhm.
and we knew people that needed money, and we would just broker the two together, and we would get a fee for it. And then the business just started growing from there. And now we have two funds, an equity fund where you have to be an accredited investor to get in, and what that means is that each of the investors own a piece of the company that makes loans,
Okay.
and at the end of every quarter, they get the profit that is left over after all expenses. And then we have a debt fund, which you don't have to be accredited to be in it. And what a debt fund does is, in this case, you have three different terms: a 1 year, a 3 year, and a 5 year term. So essentially, you're lending the fund money as a lender.
All
And
right.
so, if you choose the 12-month term, you get a fixed payment every month for 12 months, and then you get your money back. And then you can decide whether you want to get a new term or not. What I like about debt funds, there's a lot of people that will make notes, do notes themselves, originate their own notes with their IRAs, but notes pay off, and sometimes they pay off early, and it's hard to plan. Sometimes they pay off late. They ask for a payoff, but when they go to sell the house, there's the other person buying the house may have some uh, problems with their mortgage. So it may take a little bit longer. And if you can't plan for it, then your money's sitting there not earning. If the loan does pay off, now you got to wait for another loan to get into. And if let's assume you're getting 11% interest, all it takes is 2 months not to be invested, and you're down to less than 9% annualized return because you missed 2 months.
Right.
So at least in a fund where you can plan and know exactly when it's going to end and start, you know that you can keep your money invested all the time.
So
The equity fund allows you to compound over time too.
great.
So, sorry, go ahead.
So I was gonna say it sounds like, okay, with the lending side, I mean, obviously you have to have the deals and opportunities come to you in order to qualify for what it is that you guys would be willing to lend on. So there's always that, the generic formula that's out there. That's the 70% rule, right? Of what the value is. And that's what, that you're at the 70% minus your repair costs to go into it. Is that kind of what you guys
Well, it
generic
depends
look
on the
at?
property type. If it's a single family fix and flip or
Mhm.
something you're fixing up to hold and rent over time, those are generally going to be 70%. We look at 70% of the after repair value, and then we hold on to all the funds, and we will um, pay those out in draws based on completed work. When you get over to the commercial properties, and we do commercial properties as well,
Okay.
we like to, because I have that background, we like to stay in recession resistant property types. So, for example, self storage. Self storage is a great recession resistant property. We have an unhealthy relationship with our stuff, and people will pay $200 a month for 5 years to store $500 worth of crap, I say.
Yeah.
um, on the way up the economic ladder, people will buy new stuff. They don't want to get rid of their old stuff. On the way down, they're trying to downsize, but they don't want to get rid of their stuff. Aunt Martha passes away, and now they're emotionally attached to her stuff, and they don't want to get rid of it.
Yeah.
Retail, we like to do retail strip centers. And keep in mind, all these are multi-tenanted type properties.
Correct. Yeah.
And we like retail strip centers. They do not suffer from the Amazon effect. These are not businesses that are going to have a lot of e-commerce involved. They're businesses that people need to go to. So, Amazon can't deliver hot coffee. They can't do your hair, your nails, do your taxes, that type of thing. So these are nice, viable businesses. And then we like light industrial properties as well. Anything below the light industrial is typically below 25,000 square feet. We have a shortage of single family homes in this country right now by estimates anywhere between 6 and 7 million homes short based on household formation. And we have the same problem with small warehouse space because of the Amazon effect. Plus, over the past 5 years, only 2% of all the new development of warehouse space is 25,000 or less. So we now have a shortage of those as well. So it's your plumbers, it's your electricians, it's your heating and air people. They don't have a place to put their businesses.
Right.
And so we lend on those types of properties because they can become they're liquid properties. Anytime you can sell them quickly, they're more liquid than other types of properties.
Okay.
And while they're commercial and it's going to take you longer to sell, if they're multi-tenanted, at least you can get an income from them until you can sell them. From a banking perspective, if you end up having to take them back for any reason.
Okay.
So that's what you're looking for if you're on the commercial side.
So so in that regards, like so that becomes a longer term investment for you guys as the fund. Then so that's not going to be your fix and flip, single family kind of situation. These are ones
Yeah,
that are
they're
talking between
they're
like
a
3
year
and
to
5 years.
18 months typically.
Okay.
When somebody is purchasing one of those types of properties, it's also a value add like they would with a fix and flip. It's just a little bit longer of a lifespan for the fix and flip.
Okay.
So they're buying it at a discount. There's going to be some construction involved. They're going to get it what they call stabilized, but all it means is they're going to get it rented up, and then they're either going to refinance it to hold, or they're going to sell it to somebody that's where it's already earning an income.
Right. Do you
But the
guys
same
get
thing
into,
applies. It just lasts a little bit longer.
okay. Do you guys get into the modular or mobile home parks or, any of those
Well,
kind of?
we will, yeah, we'll finance mobile home parks. We like mobile home parks. They're a commercial property that the difference is um, you as an underwriter, you can only give credit for the actual land. If the mobile home park owns any of the homes, we can't really give you income value for the rent you're getting from the home. We can only give you income value for the pad itself,
Okay.
um, which is a shame. I wish I could do it any other way, but none of the other banks do. And we always have to underwrite based on how easy it would be for us to sell that note if we needed to.
Understood. Yeah.
You always, anytime you're in real estate, anytime you're in real estate, you have to have multiple exit strategies. You never want to get into one, because if it doesn't work out, then you're stuck with it.
Yeah.
So you're always looking for multiple exit strategies, and that's what we look at when we decide what property types we're going to lend on.
Nice. Well, I know, so let's obviously your book, let's touch on that a little bit, and thanks for your background of that, and
Sure.
we'll probably dive into the real estate side more, because that's a love that I have. But so tell us a little bit about the book. And you said you had mentioned about it being kind of a multi co-author. So what's the premise behind it, and what would people get out of it when they buy it?
Well, first of all, I do a lot of speaking, and it's always nice to have a larger business card. And that's what a book does for you. As a speaker, if you're a published author, frankly, it just gives you a little bit more credibility with your uh, speaking engagements.
Mhm.
And I wanted to do something that would inspire other entrepreneurs to not worry about, and I don't like to call it failure. And part of this says who failed their way up.
Mhm.
So you never fail unless you fail to learn from your mistakes.
Yes.
If you look at, and I think I'm a baby boomer, I think the millennials have an advantage in being an entrepreneur if they wanted to, because they grew up with the first video games. And there's no directions on how to get to the end in a video game. It's all trial by error. And so every time you get bumped out of the game, if you stopped because you failed, uh, the games wouldn't sell very well
True.
because you quit. And, a lot of times that's the only way you can learn is by failure. But again, you can't continue to do the same stupid things. Um, you can accelerate your learning process by being in mastermind groups with other people that are smarter than you, that have been there before, and listen to them and take their failures, or not failures, but mistakes or roadblocks that they had, into account so you could avoid those. So I always encourage people to join mastermind groups. When you become the smartest person in the room, it's time for you to find another room, because in any group, you need to get as much out of it as everyone else gets out of it. So if you're the one doing all the teaching, then you need to up your game and go to another one.
Yeah. I
But the book has got 10 other authors in it, and from all different professions. And it is very inspirational to read all the other stories that are in there on how people started, um, some of the obstacles that they had to overcome, but they just kept their head down and kept going. Um, Not everybody is cut out to be an entrepreneur. Uh,
true.
there is a bit of a roller coaster mentality, so you need to not. It's okay to celebrate your wins, but don't get super excited, because you don't want to be super depressed when you don't win either. So
Mhm.
you have to be kind of level headed and really understand it's a process. There's going to be ups, there's going to be downs. You're doing your best to expand and make sure that uh, what brought you some of the valleys, um, that if they were a mistake that you made, that you fix that. But there's also, you can do everything right, and then you have a black swan event happen that's totally out of your control, and things are going to happen.
Yeah.
It is what it is. All you can do is do your best and minimize the downside if something out of your control happens.
Well, and that's a good segue. So when we look at the current market of what's going on, right? We just came out of that high of highs in the 2021, 22 with COVID, with that change in itself, right? But then also in the real estate market being as a super high because we were riding off of the previous
Sure.
presidency. And now we're kind of in that down slope, if you will. We're not at the bottom yet, but we're in that down slope. So what are some of the quick indicators that you guys look at from the lending side standpoint because you went through the 2008, 2009 scenario, like what are some of those key points that you guys look for, in that changing
Well,
markets?
I'm going to back it up even further.
Okay.
Um, we have been on an upslope since 2010 and 11.
Hmm.
So after eight, we didn't. I don't know exactly when it bottomed out, but real estate has been on a rise since then. I mean, we've had free money essentially since then, and we've been on one of the longest up streaks in history. Uh, that was getting, and this is part of being in a mastermind. So in 2019, it was January of 2000 and no, January of 2000, yeah, 2020. So COVID hit basically in March of
Mhm.
2020. So in January, we had a mastermind meeting where a bunch of fund managers got together, and here was the premise. Everybody in there, and I'll just use us for example. The headline was Carolina Capital Management loses 50% market share overnight. What do you do? What's your plan? So that entire weekend, we sat down and all of us, the whole group, had to sit down and write out a plan of what would happen. What would we do if we lost 50% market share overnight? What was the plan of action? So we put together a blueprint of exactly what we would do if that happened. And then just so happens, you know,
Yeah.
less than 6 months later, the whole country shut down.
Yeah.
And we put that plan into action, and we ended up losing, I think it was like 24% of our business at that time. And then we had to modify a bunch of loans because our borrowers couldn't even get to their properties in a lot of cases. So we ended up with a 10% increase in profit that year because we implemented it right off the bat. We didn't try and hope things would get better. We just implemented the plan. And then as things got better, we started bringing folks back in. And so we were able to run very efficiently, and it worked out very well. So that's part of the minimizing the downside, is making sure that you have a plan in place. So let's go back to, nobody thought that 2021 and 22 were going to take off like it did.
Uh-huh.
We were all wondering, if we're going to have to start selling homes at a discount, during 2020, but
Yeah.
it completely blew our mind. And now you've got appreciation that is unsustainable. So things are appreciating at 20, 25%. And over since the 50s, single family homes have been at 3.5% appreciation
Mhm.
uh, average.
Right.
So we knew that wasn't sustainable, but you make hay while you can. And 2022, we actually hit our yearly goal in the first quarter.
Wow. Fantastic.
So that was really good. Now, uh, inflation started coming in through early part of or late 22, early part of 23, we can see headwinds coming. At that point, we were we changed our underwriting to uh, the deals that we were going to get were only going to be the solid borrowers that had plenty of um, reserves. And then the other thing that we started doing in our fund itself is that we were setting aside a lot more money uh, from the earnings to go into loan loss reserves in case we were having to take back more properties. And we've been, so we tried to minimize the properties that we would have to take back by making sure that our borrowers had plenty of wherewithal to overcome problems that they would have. And at the same time, setting aside money in case it does happen to minimize that for our investors.
Okay.
And we continue to do that now. Every single quarter, we're setting aside a lot more money than we had been in the past, just to make sure that if we have to take more properties back, we have to take losses on them, that
Is
we have that money set aside for that. And if you'll look, all the banks are doing the same thing.
yeah.
Um,
Well, I was gonna say,
and
because
it,
usually when you see the higher interest rates and those kind of situations happening and them tightening up on their underwriting, and like so now we're getting into kind of the lower part of the bell. So properties are still kind of high. It's not really the best game to be playing with the fix and flips right now, though, right?
well, it depends on real estate. You always make your money on the buy. You
Sure.
don't make it on the sale. It's harder to find deals because people think their places are worth so much more. But you always have people that are in a distressed situation and they need to get out, and you're going to get a deal there. The benefit of the housing shortage is that you're not going to see prices go down. Now, you're going to see headlines that say prices are down, but in reality, when you look at the numbers, people are getting less than what they're asking for
Mhm.
the homes. It doesn't mean that they're getting less than what they're worth because people still have an inflated view of what their properties are worth.
Correct. Yeah.
Uh, so in most markets, and real estate's local, so it's going to be different everywhere. But for the large majority of the country, real estate, single family real estate is going to stay steady. I don't see a big appreciation. I don't see any losses or big losses. Um, it's going to remain fairly flat, which is a good thing
Yeah.
because you don't want values to go down. And then when rates do start to come down, um, it'll be more affordable. Right now, it's just not affordable. But at the same time, you have to look at the general public. We've been used to free money for so long. You get somebody that's just out of college and they get a job, and the first thing they do is they go out and buy a new Lexus or a new Mercedes instead of the used Toyota, right? We have to start learning as a society to stop buying crap we don't need if you really want to own a single family home. And then there's a lot of folks that don't want to own a home. They saw their parents lose their homes in the 2008s, 9s, and 10s,
Mhm.
and they prefer to rent. And there's plenty of options for them as well. And they also, they don't want to have a lifestyle that ties them down to uh, a mortgage and a property. They're more I don't say concerned. They're more interested in experiences than actually investing now. And it's okay for them. They have a long runway. You and I know that it's better if you do it when you're younger because it's easier to save over the long term. But we also know that they have plenty of time to make it up when it's time for them to start forming a household. So right now we're kind of at an equilibrium. We're seeing loans pick up. Uh, Rates are starting to tick down a little bit, and uh, I don't want rates to tick down too quickly. I don't want the Fed to lower them too quickly because I don't want inflation to come back uh, really strong.
Yeah.
and that's what happened in the 80s. They lowered rates too quickly, and then inflation came roaring back.
So do you think
I've
that
been through a few cycles.
I was gonna say, yeah, I was gonna say, do you think that just because we're in the year of the presidency and looking at you know, that scenario, do you think that like in third quarter or right at the beginning of fourth quarter that we'll see a rate adjustment to be lower?
I think they might tick down a quarter in the September range. That's more of a possibility than I thought it was previously,
Okay.
because our unemployment rate has gone up a little bit, and while it's not at 2% inflation, it's getting kind of close.
Yeah.
So we'll see. Um, it wouldn't bother me one way or another if they just left it the way it is, because few people know this. The Fed does not lead the rates. The market leads the rates. The Fed follows.
Mm.
If you look at charts that shows the interest rates and the Fed pricing, the Fed is always behind the market. The market knows. The Fed is always following.
Okay.
Uh, but that said, you'll see indications. I think you're going to see a lot more. I don't want to be political here, but I'm fairly certain Trump is going to win, and you're going to see a lot more optimism in the business climate going forward. The fundamentals may not change much, but the optimism will make people invest more.
Certainly.
Does that make sense?
No, it totally does. Yeah. I mean, I think because, if that's the scenario that plays out, right, then because he is already in previous office, I feel like the policies and all that would be changed much faster than what they typically would. Because if we had a new president come in, typically it takes them about a year to learn
Yeah.
policies and learn what they can go through and change. And by the time they go through and put all their implementations in, it's year two into their presidency, right? So with this being a different scenario, if he does get reelected, certainly I feel like that would be something that changes. So, well,
Yeah, he
fantastic.
hit the ground running.
Yeah, definitely. I mean, he's, cleaning house and who knows what. But
Well, I tell you, one thing that does bother me is that uh, currently the current president is talking about a cap on rental, a national rental cap, yearly cap. So you're not allowed to raise your rent a certain percentage. Again, I hate, and it's not just him. I hate when any government comes in and starts regulating what business can do. Now, there are certain things that government needs to help with, but um, a national rate increase or decrease, that's none of their business.
yeah. Well, it's the same,
Because
when we run into the same business models of like the STRs and, and the midterm rentals, you have a lot of these areas because they're influenced by the big hotels or the, monopoly of those situations around some of these areas. And also, the people around, like they don't want necessarily the STRs, but there's a good side to that. There's a good business model they're adding into it. They're, typically it's, the places are well more maintained than a stereotypical rental. But I get why they want to do some policy changes, because it affects the pockets,
yeah,
ultimately.
well, what the ultimate compliment is that, yeah, your big hotel chains are lobbying not to let other people do it, but they're doing it themselves.
Mhm.
If you'll notice that Hilton and Marriott, they all have their own single family short term rentals that they do as well.
Yeah,
So they like the model. They just want it to be in more of a resort uh, setting.
yeah,
And whereas what we do, and if you're smart, uh, and I know we're changing subjects here, but short term or midterm rentals are great properties to have anywhere near a hospital, anywhere near a power station, any large company that is always adding things, and they have contractors that are coming in for a month or two at a time to do work in these places. They don't want to stay in a hotel. They'd rather be in a house that's kind of close, and
yeah,
they can still have their normal routine with dinners and whatnot. And those are not resort places. They're just neighborhoods that are, close to these facilities.
yeah. Well, that's
And,
fantastic.
and those things typically to stay, rented all the time.
Yeah, because I know that we've well being in with Wendy and some of her meetings and just talking with people in general. I know some of our local areas and stuff, they're making some changes, primarily like in, Rock Hill and stuff. And those are things that are changing within the next year, to 2 years. But the fact that that's already being implemented, is already kind of, making people change kind of the business model, because obviously it takes some time to kind of get there. But well, I want to kind of wrap up a little bit, but kind of a
Yeah.
quick summary of things. Obviously you have the fun side. So what's the best way for people to get a hold of Bill Fairman? What's the best way to get a hold of you? And then also, do you have you talked about speaking engagements? Do you have any upcoming speaking engagements that people can come see you at as well?
Well, most of what I do is in industry related stuff. So in September, you know what? I don't have the date right in front of me, which is awful. You know what? I also have a calendar. So on September the 18th in Las Vegas, I will be speaking at the American Lending Conference. It's another industry um, get together, and I'm not talking at all about the industry. My subject is the art of telling your story,
Okay.
and it helps people raise capital. It helps people bring in team members and keep them, and it helps create relationships with your customers. Now, the story isn't about you. Nobody cares about you. Your story has to be relatable to them. Sort of like the mastermind thing I was telling about. You're telling people how not to step in this particular mud puddle because I stepped in it already for you. Uh, your story you never need to be the hero in your story. Your customer or the person that's listening to it has to be the hero in that story. So I'm teaching people on how to put their stories together in a way that always makes the listener become the hero in that story. And it's something that always gets under my craw when I see people speak. They start off with, "Here's why I do what I do. Here, this is my why." Well, as a member of the audience, I could care less about your why.
Yeah, I want to know about my why and how you can help me, right?
Yeah, it's about my destination and how you can help me get there.
Yeah.
And that's what kind of has to change. So I'm doing the keynote on that, and I'll have a nice workbook on how people can put their stories together and that kind of stuff. So
Fantastic. So September
yeah.
18th. Um,
September 18th at Green Valley Ranch Resort in Las Vegas.
okay. I'll have to see if check that one out. I'll be out in LA. So I'll definitely want to talk to you a little bit more about your conversation that you're going to be having, because in LA, I'm going to be getting on stage, and I'll have like a 7 to 10 minute segment but I'll be in front of roughly about 2,500 to 3,000 people,
Nice.
and that don't know me, that don't
Yeah.
know my story or know kind of all those things. But ultimately, it's one that we have people from all across the globe that come to it. So it's more of like coming from that direction of, hey, here's the story, but it's ultimately about how, it can, the story of the growth of where we're at right now is to be able to also kind of get into um helping them, right? It's
Sure.
really kind of helping their story. Well, so I'll definitely wrap up with you on that. Love the
Oh,
conversation.
you did ask how they get a hold of me. So
Yes.
billfairman.com, or you can go to carolina.fund.
Okay. Oh, well, let's talk on the fund real quick. So on the
Sure.
fund, you mentioned about accredited and unaccredited investors. Is there when you're looking for the unaccredited investors, what is the minimum that you're looking for? And are you primarily looking through that self-directed IRA kind of scenarios?
Yeah, so it's always helpful. You can be more tax efficient if you're using your self-directed retirement account, because when you invest in lending, there are no tax benefits. It's going to be considered ordinary income anyway.
Okay.
It doesn't mean you can't invest cash, but I always tell people if they're going to invest in real estate or the real estate space, use your retirement accounts to do the lending side, use your cash to actually buy properties with, because the government gives you a ton of tax benefits owning property, but they don't give you any for making loans. So if you want to be tax efficient, use your cash for owning property, use your retirement accounts for being on the lending side. And that way you're going to be the most tax efficient because you'll be in a tax deferred or tax exempt account with your lending side of things. But on Fund 2, it's a $25,000 minimum. You do not have to be accredited. Fund 1, it's a $50,000 minimum, and you do have to be an accredited investor. An accredited investor is you need to make 200,000 a year as a single person, 300,000 as a family, or you have to have a net worth of $1 million, not counting your primary residence.
Okay. That's fantastic. All right. So billfairman.com. And then I also see through your
Carolina.
book, if someone wants to go and buy your book, where can they get that through Amazon or they get that?
Yeah, they can get that through billfairman.com too. I have a little banner that pops up, says has my book that pops up.
Perfect.
But
Actually,
yeah, you can go to Amazon
okay.
and get the Drive to Success as well.
Well, fantastic. Well, Bill, I appreciate you coming in and having the opportunity to talk with us and networking with us a little bit, and then sharing your story and sharing how people can connect with you. And well, thank you again for coming in.
Yeah.
And any last parting words?
I will leave people with this. Again, I go back to that. You never fail unless you fail to uh, learn from your mistakes. It's funny when I'm with my trainer, he's constantly telling me that you need to do this to failure, and I have to keep reminding him that I need to do it until I'm stressed so much I can't push anymore. It's not failure, it's exhaustion.
Yeah, exactly right. Well, Bill, again, thank you. And we'll wrap up and we'll see you soon.
Thank you, sir.
You as
It was
well.
a pleasure.